Welcome everybody to another directed IRA webinar. My name is Nate Hare, joined by the illustrious Aaron Holderman. We are with Direct Illustrious. That's a new one. We're getting business going here in March. So
we'll take it.
Yeah, glad to have you guys. We've got a great program for you. One of my most favorite topics to talk about, which is using self-directed IRAs, 401ks, HSAs. Not only just investing them in real estate, but using leverage like bank financing or creative financing, which I think ultimately gives a far superior advantage to investing with a retirement account, because it's not like you can use leverage to buy mutual funds or stocks in a retirement account, but your IRA can use leverage through bank financing and some other creative structures, and we're going to talk a little bit about the do's and don'ts and how to do that.
For our uber smart people out there, they say that's not entirely true. You can trade on margin.
Right. But for you real estate investors out there that are used to using debt to help acquire more property, there's a way to do that inside a retirement account and still be cost effective or tax effective.
All right, we got a lot of people. We are doing this live, so we will have a recording up. You can fire some questions over in the Q&A. Please don't use the chat. If you use them in the Q&A, then we'll be able to monitor that a little better. So put it over there in the Q&A. We'll kind of get to them throughout today's webinar, and then we'll do a rapid fire at the very end as time allows. But we got a pretty great webinar today. We got some cool case studies we're going to review, some strategies people have used. And before we get started, I guess we have a few announcements. I guess we can share the screen.
Yeah. Angel, if you want to bring that up.
There we go.
Yeah, we have our 12th annual or 12th Self-Directed IRA Summit, and we're going to be hosting it in Austin, Texas this April 25th and 26th. It is a one-day conference on the 26th, but we encourage anybody that's interested in coming. One of the secondary benefits to these events is the networking opportunity, and we're going to be doing a welcome reception on the 25th.
Yes.
If you are in Texas, please make time to get out there, whether you're in Dallas or Waco or San Antonio or Austin. Austin, it's right in your backyard. But we're also having it co-sponsored and co-marketed by the Texas RIAs, the largest real estate investor association in the entire country.
Yes, sir. I like how you threw in Waco, too. I love all you people in Waco, Texas.
Yeah, Waco,
we expect
all
you to
those
be there.
places. Yeah, Fredericksburg, Richmond, wherever you're at.
It's like we got Houston, we got Dallas, we got Fort Worth, we got Austin, and Waco.
Well, Texas is big, so.
I grew up there, so I can tease on it.
Tell them a little bit about what they can expect.
Yeah, so it'll be great. So it's primarily all on self-directed strategies. This is unlike any other event you've been to as far as like in the IRA space. This isn't like a multi-speaker, going over different investment types. This is about how you can use a self-directed IRA or other qualified retirement account to invest in alternative assets. And that's what we'll cover. So we'll have like foundational sessions, we'll have advanced sessions, we'll have a couple panels. And most of the people coming are, pretty well seasoned in self-directing. They're looking to network with other people, learn some of the cool things and strategies that they're using within their retirement accounts, specifically their Roth IRA to turbocharge those. I know one of the sessions that people always love is we do a session on how to turbocharge a Roth IRA, and we cover that for about 30-40 minutes and go over dozens and dozens of examples of how you can turbocharge a Roth IRA. So it'll be a great time. Like Nate said, come out on the 25th, get there the day before, come do the networking. We have an open reception for networking and to welcome everyone, and then we'll just have a one full day banger on Saturday the 26th, and it'll be awesome.
Yeah, and this is not an event where you're going to get pitched investments or pitched to buy into something. This is strictly an educational event and really a one-stop shop. If you're interested in learning how to self-direct, or if you're currently self-directing, you always pick up extra nuggets. I even pick up extra nuggets. I've been in the business 13 years, and I always take something away that I'm like, I didn't quite think about it that way, and that's interesting. But it's also the networking. It's a limited seating. I think we only have room for about 300, 350 people max. So tickets are limited. Don't wait until the last minute. I had people asking me the week before our last Self-Directed IRA Summit for tickets, and we were fully at capacity.
Yeah.
So
go over to sdrasummit.com and check that out, and that's where you can get registered. You can stay at the hotel or stay anywhere nearby. It's pretty close to the Austin International Airport as well. Awesome. It'll be a great event.
Yep.
Be there. Yes, you can come attend virtually. People are, for those of you that just don't want to be there in person or that can't make it, we understand. But yes, there is a virtual option, and we will be streaming that live, and you get the recording as well. But we'll miss you, so try and get there in person.
Yep.
Okay, so today we're going to go over buying real estate inside your IRA, 401k, HSA, all these different account types and strategies, and we're going to do that, covering qualified retirement accounts. It's going to be good. We do have a disclaimer. We do not provide any tax, legal, or investment advice. We don't endorse any products, services, investments of any kind. This is for educational purposes, and do your own due diligence. Okay, a little bit about directed IRA. So we are a licensed and regulated trust company. Our license is held with the Arizona Department of Insurance and Financial Institutions. We have that up on the screen there. It's actually a little outdated. We have over $2.5 billion.
Just crossed that today.
Assets under custody now, so just over 2.5. The clients is still accurate. It's over 20,000 client accounts. The company was founded by Matt Sorensen and Mark Kohler, both tax attorneys, CPAs, tax consultants by trade. So that's who founded the company. Just decades of experience in the self-directed space and working with small business owners and trying to save you on taxes. And so that's a little bit about the company. You can own almost anything inside a retirement plan. There's a few exclusions to that. You can't have life insurance contracts, and you can't have collectibles. Precious metals are not considered a collectible, but the IRS does outline what are the acceptable uses of precious metals. But what we're here to talk about today is anything that's not a secure, a public type of investment, like a traditional investment that you would have with like a traditional brokerage like Fidelity or Vanguard or Schwab, any stock, bond, mutual funds, ETFs. What we are going to talk about today is alternative investments, and that's why we exist. When you want to buy real estate inside of an IRA, crypto, invest in a syndication, do some private lending, invest in a private company, small business or startup, do promissory notes, maybe invest in a buddy's fix and flip deal, oil and gas, or what we'll talk about today, doing debt leveraged real estate. You can do that with a self-directed IRA, and that's why we exist at Directed Trust Company. Schwab, Fidelity just will not process that type of request. Simple as that. But that's okay, because that's why we exist. All right, so self-directed retirement plans can own alternative assets such as real estate, but what exactly is a self-directed IRA as far as the term? IRAs follow the same set of rules no matter where you have one. Investment restrictions usually come from the custodian of those investments. Nope, where do we go? Oh, not the IRA itself. Yeah. An IRA is an IRA, is an IRA, is an IRA. So what types of plans can be self-directed exactly? You have basically three types of buckets. You have some personal plans, you have employer plans, and specialty plans. Those personal plans, the most common ones you'll hear is a traditional IRA, and our most favorite one, the Roth IRA, which is tax-free. And if you make too much income and you can't contribute directly to a Roth, we have strategies for that. You can do what's called a backdoor Roth IRA. Just contact us. We'll help you walk through it. It's for all of you high-income earners, you W-2 people out there that just can't contribute directly to a Roth. There's still hope for you, though. And then you have employer plans. You're a small business owner. You're self-employed. You can do a SEP IRA or a solo 401k. There are some exclusions to that you may or may not qualify for. Probably the biggest one is no full-time employees. You can have part-time employees. You can have contractors. Those are fine. That's typically the biggest thing we see that you wouldn't qualify to set up your own solo 401k. Just think of it as you're establishing a 401k for your own little small business that you have that doesn't have full-time employees, just like you had used to work for somebody in the past and they had a 401k plan. And then we have some specialty plans like the HSA, or on the education side, an ESA, which is a Coverdell education savings account. And those just follow the different contribution limits as outlined by the IRS. Not a ton, but there are some cool strategies other than just investing in a stock or a mutual fund. You can invest in real estate with an HSA or ESA. And, if you started one of those, an ESA for one of your children when they're super young, by the time they're college age, we've seen a lot of clients pay for the really expensive college tuition all with an ESA and not having to pay any taxes on that. So pretty awesome. So those are the types of plans that can be self-directed. What else we got?
Well, and then I'll say this before we get into the case studies.
Yes.
Keep in mind, some of you might be thinking, well, I'm not self-employed, so I can't have a solo K, but I can have a Roth IRA.
Right.
But what am I going to do with a $7,000 contribution or an $8,000 contribution? The benefit is to our topic today is you don't need hundreds of thousands of dollars in your account as long as you have a way to use leverage. I've got two case studies. One, $6,000 investment using seller financing. Hold your thoughts on that. We'll get to that. And then I've got another $10,000 investment where a client used a structure called a joint venture. So it's not about how much money you have in the plan. It's about how creative you can be. And if you're already doing these types of deals outside of an IRA, we're just going to apply it inside of an IRA. But the main thing people talk about, if you've got on the online and you start nerding out and you start going down the rabbit hole, because I get this question all the time and I love it, it's what happens when we bring on debt and what is this thing called UBIT? So let's just attack that full force and get into what UBIT is. So if our IRAs, call it a Roth IRA, a traditional IRA, a SEP IRA, an HSA or an ESA, I'm excluding the solo K for a certain purpose. But if those plans are going to go out and through my custodian directed IRA, I'm going to buy a property and my plan needs some debt to help acquire the property. It can do that. However, based on tax code, there's a tax that will kick in to the IRA, not to you as a person, because the IRA or the plan is going to be the owner. The IRA of the plan can also be the borrower. But the plan, since it's a tax-exempt entity to begin with, there's a tax that kicks in on the debt piece. Not the IRA's investment, but the debt. And it's called unrelated business income tax. Now, I will tell you, UBIT is not something to be scared of. It's just something to be aware of. And it affects other types of entities, not just IRAs. This is not the IRS picking on IRAs specifically, but there's also other tax-exempt entities like churches and nonprofits. There's certain investments or certain structures they could set up where they also have to pay a tax. For example, if a church sets up its function as a church and has revenue being generated through the church, it's not taxed on that revenue, okay? Because it's related to the function of the church. If the church opens a side business like a bookstore or a cafe, well, then that business can generate income. The IRS isn't going to stop them from doing that, but they're not going to allow them to run a business that's not associated with the church and have that income can be completely tax-free. You want to think about this in the same regard as an IRA using debt. It's using unrelated sources of capital to help it buy property. That's not a bad thing. You just need to understand what happens when the IRA brings on debt. So if you want to nerd out, go to IRS code 26 USC 501. But here we're going to break it down
not USC the college.
Not USC the college. Okay. So what are the three circumstances? If we're just breaking it down and just talking about IRAs, HSAs, or ESAs, when are we going to see this UBIT tax kick in? There's really three circumstances. One is when an IRA owns an active trade or business. Okay. Now we're not going to talk specifically about that, but think about it this way. If your IRA would buy a Pizza Hut and the IRA didn't have to pay tax on that income, well, retirement plans would just run all the business owners out that didn't own businesses in a IRA. So it's a leveling of the playing field. The IRS says, hey, if you own a business, you're going to have to pay a tax, whether it's a person or an IRA. So it doesn't make the investment bad. You just have to understand that the IRA is not going to get away with paying no taxes if the IRA owns a business that has ongoing revenue as operating income, running a trade or business, or providing services, okay? Now, when we're buying real estate, we're not considered a business like that because our income is passive investment income, okay? Question?
Oh, yeah. Let me so we'll just hit on that right now before we get into it so it doesn't even come up. So in Matt's book, the SDRA Handbook, if you haven't gotten that, just go to mattsorensen.com, or better yet, become a client of Directed IRA if you're not already, and we'll send you a free copy. Simple as that. But he talks about it specifically, to Nate's point, on what's considered a business versus like an investment. So a lot of you may or may not be familiar with the checkbook IRA LLC structure, or having a solo 401k where you have a trust checking component to that, which gives you checkbook control. In either of those cases, though, generally speaking, Matt outlines in his book that if you're doing around 3 for the year, then it's still considered, falls under that bucket of an investment and not being a business. Now,
and we're talking 3 flips.
Yeah.
We're talking 3. If you're flipping real estate, that
Thank
can
you.
be deemed a business because it's considered dealer property, not an investment property.
But you start doing 5 and 6 and 7, then they're going to look at that and be like, all right, that's a business. So kind of as a general rule of thumb, what Matt outlined in the SDRA handbook is around that kind of 3 is the special mark that you want to hit on. So.
Yeah. And again, this is only if you're flipping property,
Yes.
which means you bought it with some leverage and you sold it within the first 12 months of ownership. If you're holding the property a year and a day, there's some tax advantages that the IRA will still get. And most people, if they're using their IRA, are looking for the long-term investment anyway. So we'll get to that in a second, but those are good points.
Yep.
The second thing that can trigger UBIT to an IRA is owning and leasing personal property. Think about it like this. Personal property is anything not attached to the ground, right? Boats, jet skis, furniture. In the eyes of the IRS, that's almost just like running a business, right? Real estate is something that's tied to the ground, right? It's tied to the ground. There's a parcel ID. The IRS is very lenient on taxation to real estate investments. Where real estate investors might get tripped up on this is if you're buying mobile homes that are not attached to the ground, right? There's ways that you can attach the box to the land, but if the box is the investment, the mobile home on top of the land, it's considered personal property. Just be aware that it might kick in if you're using your IRA to buy mobile homes not attached to the ground. But again, don't let it stop you from doing the investment. Just know that you might have to figure in a tax to the IRA to make sure it makes sense in the IRA. But the most common time that we see this UBIT tax is a subcategory of UBIT called UDFI, which is unrelated debt financed income tax. And this is specific to when an IRA buys real estate with debt on it. And we'll talk a little bit more about that. So any real estate acquired or leveraged with debt can trigger this tax to an IRA. So 1, can your IRA put a down payment down and your IRA get a loan from a bank? Yes, it can. If you go to our website and go to our resources page underneath our Learn tab, okay, you'll see a list of what we call non-recourse lenders. We'll talk a little bit about how non-recourse lending works, but you're not going to find these loans at a Wells Fargo or at a Chase, but you can find these loans at Titan Bank, nonrecourseloans.com. There's some local hard money lenders that will have some non-recourse loans. What we mean by non-recourse is the borrower is the IRA, and since the borrower doesn't have a FICO score or a credit score or a tax return, usually the banks that are loaning to the IRA are going to secure their interest to the property only, right? You're not going to extend your credit. It's not a loan that you're getting as an individual. It's a loan that the IRA is getting, and most of the banks that do these types of loans process it similar to a DSCR loan. So if you're familiar with how DSCR loans work, real estate investors, is they want to see the property first that the IRA is interested in buying, and then they're going to tell you what the IRA needs to put down as far as a down payment goes, so that the rents will cover the mortgage payments in the event that the bank has to take the property back. But it has no tie to your credit history, and they can't go after your other IRA assets. There has to just be non-recourse language in the note so that the bank just has access or recourse to the property. Again, not a bad thing, okay? And this accounts for commercial property or any type of real estate investments.
And let me hit one thing. If you need some resources for various non-recourse providers, you can go to our website at directedira.com. We have a resource directory where we outline ones that our clients have worked with in the past and currently. So you can check that out. We have probably about 5 or 6 of them listed on our site. And for those of you that are just coming in, please fire off any questions over in the Q&A, not in the chat. We're not monitoring the chat. Just put those over in the Q&A so we can see those, and we'll answer them throughout and at the end of the presentation. This is being recorded, so you'll get a copy of it too.
Okay, so next question. what is this tax, and how much is it going to cost my IRA if it has to pay a tax? This is what scares people. And again, just hold that thought, because I'm going to show you ways where you can eliminate this tax and avoid it completely. And sometimes it's not even a bad thing to pay the tax. But this is where people kind of get a little scared, is when they look, what's my IRA's tax liability on this? And remember, an IRA is not a person. It's considered a tax-exempt trust. So in order to figure out how much of a tax my IRA might pay, you have to go to what's called the Trust and Estates tax bracket. I just have the 2024 tax brackets up, but this will give you just some perspective. When you look at the income and the tax marginal tax bracket for an IRA, you can see here it gets pretty high pretty fast. So this is, again, something that you want to calculate and something you want to be aware of, because you can see it hits the top tax bracket at 37% at $15,200 and above. Okay, so there are some circumstances where you might want to set up, say, like a C Corp or an entity if your IRA is investing into a business. But with real estate, it's a little bit different how the tax works, because one, the tax is only in association with how much debt is on the property. So I'll give you a quick example. Let's say our Roth IRA is going to buy a $100,000 house, and it's going to borrow $40,000 from a non-recourse lender. In that situation, my IRA is considered 40% debt leveraged. So only 40% of my net income is subject to tax, not 100%, just the amount that I borrowed. So 40% debt leveraged equals 40% of my net income is subject to tax. But keep in mind, I said net income, because here's the cool thing with real estate owned in an IRA with debt. Just because your IRA has to pay a tax, guess what the IRA gets to use now that it normally doesn't get to use? It gets to use expenses on the debt and expenses on the property to offset the income. It can even use depreciation, and it can even use long-term capital gains treatment if you hold the property a year and a day. So don't get stuck on the tax. Think, how can I offset the tax? And again, a lot of the investments that I've seen, especially on highly debt leveraged property, if you're holding it over a period of time, it can also be an advantage to increase your cash on cash return. And you just got to look at the tax as a cost of doing business, but at least know where to go to figure out what tax we're talking about. You go to the Trust and Estates tax bracket. So what are some solutions? And then we'll get into case studies. What are some solutions to help you avoid it or minimize this tax? Well, one is loans don't trigger UBIT. So for anybody who's lending money secured by real estate, you don't even have to worry about UBIT, because you're a lender and you're already in a passive position. So we always have, us lenders always say, loan don't own, right? You can avoid that tax completely. You can also use different structures. We've got I got a case study on how an investor used a joint venture as a structure instead of a lender-borrower situation where he just brought another party in as a partner, and partnerships typically don't trigger UBIT or UDFI. We'll get to that in a second. We kind of mentioned, if you're investing into a business that's got some operating income and some ordinary income, it's kind of hard because 100% of the profit is subject to tax. You don't get to use the debt function like real estate does. But one of the coolest strategies you can use for IRAs investing into businesses where you just really can't avoid the UBIT at all, but you can minimize it by setting up what's called a C Corp blocker. I don't know if you want to talk a little bit about the C Corp blocker and how that works.
It's pretty straightforward, but I will say this. You'll want to connect with an attorney or your CPA that knows how to do it. And I've had a number of questions that have come in that have prevented some of you from taking action because of this very thing we're talking about with, your CPA or tax professional just not knowing the rules on UBIT and UDFI and what that looks like. And so let me give you a resource that's super valuable that, again, do your own due diligence. There's a bunch of them. But Mark Kohler created the Main Street Tax Pro Network, and he actually has his own certification and course where he's taking CPAs and enrolled agents and other tax professionals that want to learn these strategies and help you, that understand how to use a self-directed IRA to do these types of alternative investments and to deal with UBIT and UDFI. And so just go over to markjkohler.com. You can go to his Main Street Tax Pro link on the site, and he lists everybody that is certified as a Main Street Tax Pro. Yeah. And so there's plenty of them throughout the country. I'm sure you can find one even in the exact city and state that you're in if that's important to you. So just do that as a resource. Keep that in the hopper, and don't let that be something that's holding you back from taking action and doing a deal like this.
And just wait till the case studies, because you'll see
Yes.
debt can be your best friend. Okay. Now, other ways to avoid it: if you're buying real estate and this real estate's going to have debt on there, and you're self-employed, do it in a solo 401k. That's not investment advice. That's just the smart way to do it. The solo 401k has a built-in exemption to UDFI, not UBIT, but UDFI, unrelated debt finance income tax. You just don't have to pay it. So if you're self-employed, no employees or their contractors, do your debt leveraged investments in the solo 401k. You don't even have to worry about reporting it. It just doesn't exist. Okay? Or if the investment is a good investment and it outpaces the return you would make in your other opportunities like the stock market, just do the investment with debt and pay the tax. Sometimes it's not the worst thing in the world to leverage other buckets of money to buy an investment that you couldn't have bought otherwise, because either you didn't have enough money in the IRA, or you just want to buy 3 properties instead of 1. Sometimes the debt will increase your cash on cash return, so it's a pure money play, and mathematically it makes sense. So let's look at some real deals, okay? The first deal is a client of mine that bought land in Las Vegas, okay? Now, on this particular deal, I'll give you the story. He was a doctor. He was a very busy guy. He had a pretty large amount at his Fidelity account in some mutual funds. And the reason why he wanted to look to structure a deal with debt is because, one, it was a land play. There wasn't going to be a lot of rental income or lease income while he just bought it and hold it. But he had some developer friends that he figured, if I can tie these properties up and I can get this land owned in my IRA, I'll just sell the land to some of my developers for a handsome little profit. So what he did is he first went out to find a bank that would give his IRA a non-recourse loan. Now, I brought this example up for a reason. It's going to be harder to find a non-recourse lender that'll do loans on land. I'll just tell you that right now. Most of the non-recourse institutional lenders want income-producing property, like a single-family house, rental, small multifamily, 4-unit, 5-unit. There's some that might do some multifamily. Land, it's a little hard for most banks to do land, because if there's no income being generated from the property, they're really at the subject of the safety net only being the equity. And if the equity comes down or the property goes down in value, then the bank is really just, they're getting a little uncomfortable.
So use a private lender.
Yes.
That'll do a non-recourse loan, which you don't have to use a bank.
Right.
You can use a private lender. And it just has to be non-recourse.
It just has to be non-recourse, which just means in the note there has to be non-recourse language saying that the lender only has recourse to the property and doesn't have recourse to the IRA or the individual, because you can't extend your credit to your IRA's investment. Now, he found a lender actually through his community bank. Okay? Community banks are sometimes a little bit more flexibility in their loan terms, and he was a very, very good client of this community bank. He had a lot of money with this community bank. So he walked in, he talked to his banker and told him what he was looking to do, and the banker said, sure, Todd, we'll give your IRA a loan. We just want at least 40% down. And he said, that's fine. Okay, so the purchase price on this land was $299,000, and Todd opened his self-directed IRA and just moved over enough for the down payment and a little bit extra for some potential holding costs. So he found a property that would lend his IRA 60% LTV, so actually put in 40% down, 60% was the loan. Todd did not personally guarantee the debt. Very, very important. You're not extending your credit to the IRA. Again, the IRA is the borrower. The IRA has to qualify through the bank, and usually the non-recourse language will solidify the bank from having to have a FICO score and all that, because the recourse is the property. Now, in this particular deal, the bank agreed to loan the IRA a 6% money on 6% on a 20-year interest-only note. We signed the note as the IRA custodian. So if there's any note paperwork or any purchase documents, obviously those come to us, and we sign at your instruction as the buyer, since the IRA is essentially the buyer and the borrower. Now, he's going to trigger UBIT here, but you'll see that this was a smart play from beginning to end. Now, first, your considerations going into a deal like this is you've got 2 types of income that could be taxed on real estate. You've got your net annual income, which includes your rents or your lease income. But remember, it's net annual income, not gross. So you do get to use expenses and other forms of tax offset to whittle down that income.
So Nate, hold on, because I'm going to have you repeat that. Mm-hmm. Let me do a pattern interrupt, which is a technique and strategy for grabbing people's attention. a lot of you are putting in questions about taxes, depreciation, cost seg stuff. There's times where it makes sense to use a self-directed IRA to defer taxes or not pay taxes. And there's other times to not be using it when you're wanting to deploy some of these other strategies to offset other income and stuff that you have outside of a retirement account. So now let's go back to the slide. Let's hit on this part of the case study of this net annual income versus capital gains.
Okay, so this is just, again, you're just trying to calculate how much tax my IRA may have to pay. So we're talking about the net annual income minus expenses. And then the bigger tax, really, if it's a good investment, is you're trying to see what the capital gains tax is going to be to an IRA. Now, normally, if an IRA buys property cash, there's no capital gains tax whatsoever. But if our asset is debt leverage with some outside financing, then you're gonna the IRA is gonna be responsible for a tax on the percent of the debt. But here's how that works, guys. When you sell a property in the IRA and it's got debt, the IRS does not want to go to the beginning of time to see how much debt was on that property at the beginning. They only go to the past 12 months of indebtedness. So let's say that you bought a property today in your IRA with debt, but you held it for 20 years. Okay, what's happening over 20 years? Well, hopefully you've got some rental income coming in that's paying down the note. The property is going to appreciate in value. So with the property value going up and the note getting paid down, your debt leverage percentage is decreasing over time. In a perfect world, if you were to sell the property that started with debt, but you sold it and there was no debt on the property the last 12 months, you would essentially pay zero capital gains tax because there's no debt the last 12 months. So it's all about whether you're buying and holding. If you're flipping, you might get eaten up with the tax, but if you're holding, you could probably pay a lot lower tax. And here's the other thing. Remember the trust and estates tax bracket we mentioned, and we saw that high 37%? That only kicks in if you're flipping property before a year and a day. As soon as you hold that property or your IRA holds that property for a year and a day, guess what it gets to use? 20% long-term capital gains, just like people do. So bam, that just reduced our tax liability considerably just because we held the property a year and a day. Okay, so with that being said, here's the numbers on Todd's deal. Okay, so his IRA bought the property for $299,000. They got a non-recourse loan for $179,400. The down payment from the IRA, which was important to Todd because he didn't have to liquidate his entire mutual fund, the IRA only put down $119,600. Okay, you've got some lender and closing costs, obviously, for dealing with the non-recourse lender. You've got the interest payments that are payable out of the IRA, and that's a function that we help you with. If you've got an IRA LLC, great, you can just make the payments out of there. But he's going to have at least 12 months of payments while he's holding this. But he held this for 2 years, guys, and then he found a developer friend that wanted to buy the property for $425,000. So when they sold the property, okay, he had a total profit after everything of $92,811. But hold on, now there's the tax. What's the UBIT tax, or in this case, what's the UDFI tax? Remember, he had no income on this property because it was land, so if you've got no income, you've got nothing to tax. You're only talking about long-term capital gains on a portion of the capital gain, which is the percentage that he had in the last 12 months. So the total UBIT paid out of the IRA was $11,137, giving his IRA a net profit of $81,674. And this is the important thing, guys. This is why you should not be scared of this tax. If you divide the $81,000 into his down payment, okay, that gave his IRA a 68% cash-on-cash return. Phenomenal deal. What would it have looked like had he not used the debt? If he wouldn't have used the debt, the purchase price is the same, the closing costs are less, the sales price is the same. He would have had more profit, $120,000, but you divide $120,000 into $299, which have been the whole amount he'd have to come in with without getting the lender out of the equation. His cash-on-cash return drops down to 40. Mm-hmm. So what do you think Todd did when he found out he can make a 68% return with debt and 40 without? He bought 2 pieces of land. Right? So that's the important thing. He made more money by utilizing the debt to go 2 pieces of land instead of just 1. So it's all about cash on cash return. So in that case, you bet. If it makes sense mathematically, utilize the debt to your IRA's advantage.
Did you come up with that?
What?
You bet?
Yeah.
Did you come up with that?
You bet.
Okay, we're gonna hold you to that.
Trademark that.
Yeah.
Okay. Okay. What's another way?
Trademark it, write a book.
What's another way that we can minimize the tax in this case? Well, remember what I just said. If you hold the property and you hold it until the debt's paid off, there's no capital gains tax whatsoever. So let's talk about client Paul. Paul started with a $70,000 rollover IRA from his old company, Motorola. Now, the first thing Paul did, I will tell you, and I don't have it here. I do have it here. Okay. Paul was in his mid-50s. Paul knew he wasn't retiring on $70,000. Now, a rollover from an old employer plan usually dumps into a traditional IRA. So what do you think Paul did before he did any investing with creative financing? He paid the taxes on the 70 to convert it to a Roth.
Roth conversion.
Very, very smart. He ponied up and paid the taxes before he grew it because he knew he had to grow it at his age.
And you can do that with that current, employer plan before even rolling that over to directed IRA.
Yeah.
You can just do the conversion where it's currently at and then open a Roth IRA with us at directed IRA and just bring it on over.
Yeah. So after he did the conversion, he had a self-directed Roth IRA ready and set to go. Now, here's where Todd took his real estate experience to the next level. This was back in 2012. There was a lot of people that were still underwater on their property. They owed more on their property than it was worth. And there were a lot of people still walking from their property if they couldn't negotiate terms with the bank. So what Todd started doing is he started looking at these deals that were on MLS and then had expired listings, and found that a lot of these people that he was talking to were people that real estate agents said they couldn't help because they didn't want to deal with the short sale. Real estate investors were passing on deals because there was no equity on it and they couldn't make money today on it. But Todd was looking at these very differently. All of these houses had homeowners in it, so they were all in good condition. All of these homes were scattered through Houston, Texas, and Austin, Texas, and they were all in great areas where the rents could cover the mortgage payment very easily. So back in 2012, what he started looking for his Roth IRA were these properties with no equity, but the rents covered the mortgage. And he found there wasn't a lot of competition on these deals. And the thing about these deals that interest him about putting them in his Roth IRA was these were long-term plays, because the only investment the Roth had to make was an investment to catch up the mortgage payments or past due property taxes, maybe some cash for keys to the homeowner, and structure the deal in a way where he's taking over the underlying mortgage on the property. Now, some people are saying, well, Nate, doesn't it have to be non-recourse? If you're buying property subject to, the loan is not recourse to the IRA owner or the IRA. It's actually still recourse to the old homeowner. But in most cases, this was the best solution for the homeowner because a lot of them were facing foreclosure and were about 2 weeks from having a foreclosure on their credit. So what the client Paul decided to do, he started looking at these situations as good investments to put on the shelf in his Roth IRA. Small investment up front, maybe $15,000 to catch up the mortgage payment and give some cash for keys. Title was deeded to the Roth IRA, and then he just had a property manager put tenants in there, and he's been renting these properties out for the last 15 years. So he's paid a little bit of U-bit on the net income, which is very, very small, because remember, the interest on the notes is a tax deduction. There's a lot of ways you can offset the income. His main thing was having properties owned free and clear that he picked up for $10,000, $15,000. So as the tenants, as the renters have been paying off these notes, the notes have been getting down in value, and today his Roth IRA owns 5 properties free and clear, all in Austin, Texas. And if you look at the median house price in Austin, Texas, that's about $700,000.
It's a lot.
It's a lot. So Todd has a $3.5–4 million Roth IRA that started with a traditional IRA, and he didn't do a bunch of day trading or mutual funds. He bought 5 deals over 5 years, put tenants in the properties, and let the tenants pay off the notes. And what he's been doing as rents go up, guess what he does with that additional rental income? He accelerates the principal pay down.
Let's go,
notes.
Paul.
Let's go, Paul.
How can we get some more Pauls and
yeah, so
Susans?
So again, guys, that I wouldn't even say those seem like home runs to people, but all he did was buy 5 deals and get five tenants. That's all he did.
I got one for you.
Go ahead.
So what if Paul didn't do a Roth conversion, and he did it with his traditional IRA, and let's say it was an IRA LLC, but the traditional IRA was the single member of the LLC.
Yep.
Can he get that into Roth now that he owns these properties? How would he do that?
You can, but what you have to do is it's different. Doing a conversion of an asset is different than doing a conversion of cash, right? Cash, you know the value. If we ever have to do a conversion on an asset, and we do a lot of these, you've got to provide us an appraisal so we can see what each property is worth. Based on that appraised value, you can decide, I want to convert X amount a year. And we call this chunking. Matt talks about it a lot. Aaron talks about it a lot. They do chunking. Okay. Now, hopefully you do the conversion before you have to start chunking. But most of the time when you're doing chunking, it's because the IRA grew to such a value, you can't pay taxes on $4 million in 1 year.
Yeah. So you don't have to do the whole thing.
No.
But you are going to need assistance in doing that with a tax professional or an attorney.
Yeah. And I would say this,
do
if you're going into an investment and you know you're going to utilize leverage, and the strategy is done in a way that you think that you can make a healthy profit on this, just convert before. Don't wait, especially when you have the ability to use leverage. Convert before you do it, and just convert, and everyone's different, but convert enough to do each investment. Paul didn't do a $70,000 conversion at first. He did a $10,000 conversion and bought one house. Then he converted a little bit more. It all totaled 70 in the year, but he just converted a little bit each time before he had to deploy more funds to buy a new investment.
Okay, so let's say Paul, here's be another example, and this has come through some of the questions that we have here. It's like, hey, I just don't have enough to, hey, let's face it, in most markets today, it's like, the average home price is well north of like $300,000 in most markets. And so, okay, I don't have enough in an IRA, and I don't have quite enough to do a non-recourse loan plus the IRA as far as the down payment is concerned with the IRA. So what are some things that you could do so you could still use your IRA? And we do have a lot of clients to do what's called a multi-member IRA LLC. And that is a structure and strategy that allows you to combine a traditional IRA, your Roth IRA, a spouse's IRA, and even your personal funds.
HSAs, ESAs for the kids.
So it could be qualified and non-qualified accounts, or even another LLC business that's really personal funds again. But those can all be members of the LLC with their pro rata membership interest. You'll need a law firm to set that up. We can do that at KKOS Lawyers. We're happy to help facilitate that at Directed IRA and get that structure and strategy set up. But I will say this, it is a little bit more complicated. It can be done, but that money is like locked and loaded. So if you're like doing that deal and you're like, hey, I need, I got to fix it up, or it needs some improvements, every member has to contribute their pro rata interest into doing those types of improvements or to make an additional capital contribution. And the same rules apply if somebody's wanting to take a distribution. Everybody's got to take a pro rata share as well. The alternatively, you could just wind it down and sell it, or another IRA could, buy it. Like, there's some different things that do that, but that is a cool strategy to be able to do that. And you can also, of course, do it with the solo K as well.
And the other benefit too to this Roth conversion, getting back to that, is Roths become vitally life-changing and important once you have a Roth for 5 years and you're above the age of 59 and a half. So in this case, Paul has his Roth for 5 years and he's above the age of 59 and a half, which gives him the ability to take what's called qualified distributions. He can now take qualified distributions for the rest of his life, tax-free and penalty-free, and keep reinvesting, sell some houses, buy some small multifamily. He can keep investing his Roth IRA and live tax-free off of the income. Had he done that in a traditional IRA, you've got not only the tax when you take distributions, but you've got RMDs at 73, which forces the IRA owner in some cases to sell property just to pay the IRS. What happens is your kids and your grandkids get less assets when you die. So in his case, since the taxes were paid at the time of the conversion, when he dies, this $4 million Roth IRA, it just turns into an inherited Roth IRA to his kids, who get to live tax-free off the distributions for another 10 years. So multi-generational wealth, and he started with a $70,000 traditional IRA.
Yes, sir.
All right, go Paul. All right, so what's in a way to avoid it? Well, if you're self-employed and you have no employees and you qualify for a solo K, just do your debt leveraged investments in a solo K. Okay, here's a friend of ours in Houston, Texas. Okay, he's a commercial real estate broker, and he was very young when he did his first deal. Okay, early 30s. Okay, early in retirement, I would say. He had a $6,000 IRA that he had to E-Trade at the time. But he was self-employed. He was always a real estate agent, started as a residential, just a normal real estate agent, went to commercial. So what he did is he set up the solo 401k. He rolled in his E-Trade traditional IRA into the solo K, and then again converted that to a Roth. So he had a Roth 401k before he did any investments, okay? Now, what he found as he was looking for some commercial property for one of his clients is he found a lady that had recently been widowed, and she had a problem on her hands. The problem on her hands was the tenants in the 3 warehouses her and her husband owned. Now, the husband was the main person that was doing all the day-to-day on these properties and making sure that the tenants paid rent. When he died, they started taking a little bit of advantage of her. So she didn't like dealing with the tenants. It wasn't in her wheelhouse, and they had 3 paying tenants at the beginning, and as soon as the husband died, they had about 1.5. One tenant stopped paying altogether, but was still operating as a business. Another tenant was paying very, very sporadically, and she just couldn't get him on the phone ever. And then the other tenant in warehouse 3 was always a good paying tenant. But the problem was the tenants, not the real estate. So what our friend Randy asked to do is he said, well, if you don't need the cash from these warehouses, but the main thing is you like the income when the tenants are paying, you just don't like dealing with them, what if I could structure a deal in a way where I can make payments to you and I'll deal with the tenants? She said, yeah, that would be great. So long story short, what Randy structured is that his Roth 401k with the whopping $6,000 in it would give a down payment to the widow of $6,000 and carry back a note on the 3 warehouses for $94,000. So they structured a purchase price of $100,000, gave a $6,000 down payment, which was the investment capital, and the 401k leveraged the note to the widow. But the 401ks now, remember, pay no tax, no UDFI tax on debt. So with this creative strategy, seller financing, he was able to pick up the 3 warehouses for a small price. Now, what he did immediately once the Roth 401k took title to the warehouses, he got his property manager in play. He can't do this himself. He can't extend that kind of service, but he has a non-disqualified property manager. And all the property manager really had to do was cut down a tree that was kind of blocking one of the parking lots, got one of the tenants out that stopped paying, got an immediate tenant in there within 4 business days, got the second tenant to start making on-time payments by just having a little bit more structure in the communication. And then the third payment was fine. So from the first week of ownership, the property manager got 3 paying tenants on these warehouses. Now the tenants are now paying the 401k because the 401k now owns it. And what the 401k is doing is making the note payments to the widow. Okay, tenants make payments to the 401k, 401k makes payments to the widow. He keeps this going for 16 months. Okay, warehouse number 3, the tenant in there has a child. Says, hey, I'd like to own my warehouse. Is there some sort of structure where I can buy my warehouse or own it outright? And Randy says, sure. So they structure up a sale agreement that the 401k would sell warehouse number 3. Now, properties had increased in value. The market was super hot back then, and the income was great on this property, so he can justify a higher price. The higher price on that warehouse 3 was enough capital to pay off the note to the widow completely, which enabled Randy's Roth 401k to retain ownership of the other 2 warehouses that are still cash flowing today, and each worth about $100,000. And how much UDFI tax did he have to pay? How much UBIT was it responsible for? 0, because it was done in a Roth 401k. So again, that's a $6,000 investment just using a strategy of seller financing to turn a small Roth IRA into a very decent sized Roth IRA of 200 grand. And he did this first deal in his early 30s. Okay. What's another way that you can structure to avoid this tax? And this is a little bit more creative, and there's a lot of cautions to this, but the tax on UBIT or UDFI only comes through ownership, okay, or debt. If you can eliminate the debt piece on real estate, you eliminate the UBIT. Okay. So what's a way that you can eliminate debt? You don't have a lender. Okay, you don't turn the IRA into a borrower, but you maybe structure a deal where you have partners. Okay, now this can be done a lot of different ways. You don't even have to do it as a joint venture. You could partner together with personal funds. You can partner with other IRAs.
Tenants in common.
Tenants in common, right? There's other ways that you can bring in other buckets of money, but as long as there's no lender and no lien, there's no debt, so there's no UDFI. So here's a story of a client of ours in again, Houston, okay? Now, I'll tell you, he was a guy that was a real estate investor by trade. He also had his own construction company, okay? Now, when you have your own construction company, you can't use a construction company to build on a property that your IRA owns. So that's one piece of this story. But first, where did we end up with this? Where do we start this story? Our client John had a person approach him one day, and he was working in a very rough area of Houston, by the way. If anybody knows the Third Ward was not an area where you wanted to jump in and buy real estate. He was jumping in before anybody else jumped in. And you had a lot of property there that were owned free and clear. The area kind of demanded a lot of, relationship building, I would say, and he had a good relationship with a lot of people in the community. And a lady had approached him who had not paid her property taxes in 5 years and was facing foreclosure by the county assessor. Okay, she didn't have any income, and she had turned the house into a hoarder house. And nobody wanted to buy anything in the Third Ward, and nobody wanted to buy a hoarder house in the Third Ward either. So he was even a little hesitant as to what do you do with this house, but he wanted to help the lady out. Now, he was in his mid-50s, and he had just started a Roth IRA for the first time, and he made 2 years contributions. This was back when contributions were maxed at $5,000. So he had $10,000, 2 years of contributions in his Roth IRA, and decided he didn't know if he wanted to buy the property or what. It was probably only worth about $30,000 at best case scenario. But he wanted to keep this lady in the home, and they structured an agreement called a real estate option. Okay, now I'm not going to go into real estate options, but it's basically just you're paying consideration to the homeowner to have the first right to buy the property, and they can't sell it to anybody else over a specific option period.
It's an option contract.
It's an option contract, right. The Roth IRA is the part of the option contract, okay? So what he structured was that the Roth IRA would give $10,000 of consideration, okay, to the homeowner, okay, let her pay her property taxes. He actually paid the taxes for her and let her keep a little bit of money and said, you could stay in the house for 2 years and I won't bug you, but I'm probably going to exercise my option. So it gives you some time to figure out what you want to do or figure out where you need to live, because she couldn't afford the house. She didn't have any income. Okay. So he just has an option being held in his Roth IRA. Now you've got 4 considerate. You can exercise the option. You can let the option expire. You can assign the option to another person, or you can cancel the option. The homeowner found some family up north to move in with, so now he's got the house. Now he's got to decide if he wants to exercise the option, which he did. So the Roth IRA took ownership of a hoarder house in the middle of the Third Ward. Now what do? He didn't have any more money in the Roth IRA. He couldn't bring his construction company in there and start doing anything to the property. But construction people have a network, and he knew another friend of his in the other town that had a construction company. He knows a guy that knows a guy. You got to use your network sometimes. We call them financial friends, or just leverage your network. Your network is equal to your net worth. So he reached out to his other construction buddy, and they structured a joint venture. The 2 partners of the joint venture were Roth IRA that owned the property and construction company that was bringing in the construction costs and, more importantly, the sweat equity. One of the things with joint ventures is you cannot have the IRA in the position of the sweat equity, because IRAs don't put up sweat equity, but it can put up capital. You have to have a non-disqualified person bring in sweat equity, and that's what he structured. Yeah.
So I did the same deal on a spec house in California. So the IRA did the land, purchased the land. Contractor went and did it, got a non-recourse loan from a hard money, person that did the, disbursements based on the milestones for the build, and we did it. Me and the general contractor did a joint venture agreement.
Yeah.
They're easy.
Phenomenal. They're phenomenal in the right circumstance. Okay, and in this circumstance, what made most sense is to bring in that construction company as a partner, because remember, partnerships don't trigger the UDFI tax because it's not a lender-borrower situation, it's 2 partners. So as a part of the joint venture agreement, it spelled out very clearly that the construction company would bring in the sweat equity, bulldoze the house, build 2 townhomes on their money, and then split the profits 50-50 when they sold the properties retail. Long story short, it took about 2 years to do this, but they sold the properties, okay, and they split over $500,000 of income, which netted the Roth IRA, his Roth IRA that put up $10,000, a check for $297,653 and no UDFI tax because it was structured through a joint venture. So that is a win-win, and that's just a creative real estate investor using a small amount of money and structuring it in a way to put in tax-free dollars into his Roth IRA without being affected by the UDFI tax.
Awesome case studies. Let me hit on some prohibited transaction stuff. Yeah. So got a lot of, we call them PTs is the slang word, but it's prohibited transaction. There's a couple things like not doing deals with disqualified persons. That's, just think of it as like your lineal family tree. So, brothers, cousins, aunts, uncles, sisters not included in that, but like spouses, kids, grandparents, in-laws, like, no go. Yeah. Even step parents are okay. So here's what I'll say to, like, kind of oversimplify it. Start the deal with the qualified account, with your IRA. You can't go then, buy it personally or buy it with another LLC. And I got this great deal under contract, but I'm going to, like, give it to my IRA. Can't do that. It's got to start with the IRA or the solo K. So just remember that. And also, you're not investing your IRA into the LLC that already owns the property. You can't do that either. So those are probably the two biggest ones we get all the time, where you have, like, a cool rental portfolio and you're like, Nate, Aaron, I just want to get that into my Roth. It's not happening. Yeah. You can't do that. So sorry to be the bearer of bad news, but that's just how it is. So it's got to originate with the qualified account. Now, can you invest in a company or a deal that you're also a partner in, like a general or limited partner? We get that asked a lot too, or a percentage of that. What I'll say to this is it can be done. There are some rules and things that have to be taken into consideration. You're going to need to discuss with an attorney how that deal is structured before that would pass with, the investment, team with the self-directed IRA custodian. Typically, though, you're not 50% owner in that other business. It's well below that. Again, there's certain rules and things that, could be done, but seek out professional guidance for that.
Yeah, the IRAs just have to start at the beginning and enter into contract and buy the property. So just going forward, you guys want to look at it. And here's what I say. Think back to the case studies now. Think back of Paul's situation. He found deals for his IRA that were very different than deals he was doing personally. He's still a real estate investor by trade. He was flipping properties outside of his IRA because that gave him income to feed himself and pay for things for the family. The deals that he put in his Roth were the deals on the shelf that he bought subject to, where it needed a little bit of time so that the renters can pay off the notes for him. So don't pigeonhole yourself into just doing the same types of deals, because oftentimes deals fit better in an IRA or vice versa fit better personally. So you just want to identify which one's best, but you should be doing both. If you're a real estate investor, there's deals that you should be doing in your personal name, but there's also deals you should be doing in your IRAs based on how they structure and if you want to create long-term tax-free generational wealth.
Nate, did we hit on syndications with a Roth or traditional IRA?
We can hit on that, because that's
a UBIT, UDFI, when you're investing in. Okay, first of all, a syndication is a private company that you're investing into that has a private placement memorandum. Let's say the most common one we find, they're investing in real estate deals.
Yeah.
Okay, and let's say the minimum's $50K or $100,000, and you're taking your self-directed IRA and you're investing into that private syndication. Obviously, there's a lot of debt and other things those syndications are using to go acquire these multifamily or commercial type of properties, or maybe a single family portfolio. You want to hit on that?
Yeah, so I do. So if a syndication or an entity has real estate that has debt on it, and your IRA is a investor into that entity or syndication, then yes, the debt piece will flow through to the IRA, and the IRA may be subject to UDFI tax. I say may, because oftentimes, not all syndications, but oftentimes on these syndications, what they're doing is they're buying a property that's maybe a D or C class, right? They're putting in new management. They're doing some, value add strategies. And a lot of times that takes a lot of time. They're not really making a lot of income on the investment until they really sell it down the road. So your IRA custodian might get a K1 that shows what the investment is worth, but there might not be a lot of income. So if there's no income, there's no tax. The other thing is they're also using cost segregation and some accelerated so you can, a lot of times you're getting a loss.
Yeah, they're the ones using those depreciation, those tax depreciation strategies, not the IRA.
Right. So
they're using that.
But that tax credit now, that tax advantage goes through to the IRA. So if there's some losses you could carry forward those losses from your IRA to offset future income to the IRA. So again, it's not something that should be. You really need to talk to the investment sponsor, figure out how the investment's supposed to be structured, and don't worry if there's losses. Good. If there's low amount of income, good. It's all about when they sell the property, and oftentimes what they do when they sell the property is they've increased the value of the property. The debt's still the same. They may refinance out at the very end, but again, your capital gains tax is based on the last 12 months of indebtedness, not the last month of indebtedness.
Now you go back to that last case study before we. Okay, so on the joint venture. So the question Roger's asking. The guy who optioned the hoarder house, where did he come up with the money to buy the house when he exercised the option? I'm assuming the Roth IRA bought it, but didn't he spend what little he had getting the option contract?
Yes.
Just clarify that.
The purchase price on the option contract was equivalent to the consideration. So that was the purchase price on the option as well, $10,000. He could have made it for more, right? But the lady was in such need of the money, they needed to do something right away. And remember, this was a hoarder house. It wasn't worth a lot because it needed to be bulldozed, so there was almost... You could argue there was not a lot of value in that property.
Okay, go back to that last slide on how they can get in touch with us if they have other questions.
So now you've got some helpful information. Now we hope that you guys who are on the fence see, okay, this tax ain't so bad. In fact, this tax may be a good thing if I can leverage the debt. Guys, if you do not have an account set up with Directed IRA, okay, we've got some cool little promos for you guys if you want to open accounts. And we're talking traditional IRAs, Roth IRAs. If you just left your employer, you got an old 401k or a TRS or a TSP, those can be rolled into self-directed IRAs. If you're self-employed, set up a solo 401k, especially if you think that you can find some deals that involve some leverage. Set up the solo 401k and get a little bit in there. You've seen here, guys, you don't need a lot of money. We saw a case study with $6,000. We saw a case study with $10,000. For those of you who haven't made your 2024 contribution yet, open the account and at least get last year's contribution in, especially for you people that don't have Roth IRAs. Remember I told you, or we told you, there's a 5-year seasoning on Roth IRAs so that all the earnings can come out tax-free and penalty-free if you're 5 years and 59.5. If you've never had a Roth IRA and you set one up today and make a contribution for 2024, guess when your start date is for your Roth IRA? January 1st, 2024. You're already 16 months into that 5-year clock. So the point is, get the account set up, get a small contribution in if you can, at least start the clock, and use the promo Webinar 50 on any application that you submit to us. If you scan that QR code, you'll get to our wonderful IRA executive team. They're all very well trained. They can help establish your account. Everything we do now is online. It's electronic signature. It literally takes 5 minutes to open an account, and you can fund it the very next day, just linking your bank account through Plaid and get money in it. The longest thing that you're going to have is just go out and find a deal. If you've got deals that you've already eyeballed, get the account set up and get it funded. That way you're ready to rock and roll. You've got the vesting for the IRA, or if you want to use the IRA LLC to simplify everything and have a multi-member LLC where all your accounts, I just set up a multi-member LLC for a client that had 12 accounts, right? Roth for him, traditional for him. Roth for spouse, traditional for spouse. They had two SEP IRAs, and they also had ESAs for their kids and an HSA. They set up all those accounts, and all of those accounts are in one place, the IRA LLC business checking account, and now he can go out and do deals where all of those accounts receive the benefit pro rata, and all he has to do is deploy funds right from the business checking account. So it could be a massively helpful solution for those of you who are trying to use multiple accounts and have it all.
Okay, so in summary, we'll have the recording up. If you have additional questions that we did not cover, go over to directedira.com, hit the appointments link up there in the upper right on our website, or you can scan this QR code here, but just go to directedira.com. You can book a call, and we will answer any questions we are not able to get to today. If you use the code webinar50, you'll get $50 off your first year annual fee. So you're just giving you all sorts of savings today. Saving with an IRA.
Saving left, saving right. Saving your taxes at the same time.
Remember, we have the IRA Summit in Austin, Texas, April 25, 26. If you want $50 off, I'll hook you up, since we did talk about Mark and his Main Street Tax Pro Network. Just use the MJK50, you'll get $50 off. Okay. And you can use that code for the SDRAsummit.com, and you can get a discount of $50 off. So, What else do we got?
That's it. If you guys got questions about the webinar itself, you can always shoot me an email as well, or book a call with me. I'd love to help you guys. And again, you'll get the recording. Share this with a friend. Share this with a family member, and let us know if we can help you along your journey to self-direction.
Book a call and let us get to the rest of those questions. We have so many wonderful IRA account specialists here at Directed IRA. I'm just looking at a handful that we weren't able to get to, but we're a little past the top of the hour. So book a call with us today, talk to them. We'll answer the rest of those questions that you have. You can spend 10, 15 minutes if that's all you want. Great, we're happy to do it and get you an account open at Directed IRA.
Thanks
so
guys.
much.
Hope this was helpful. See you next time.